Hi all, welcome to i-tutor Academy. In today's session, we will start with the Unit 8, subsection 8 of MMPC 010. And last sections we will discuss on last videos, so please refer that. And it's short run and long run cost. So the short run is defined as a period in which the supply of at least one element of the input cannot be changed. To illustrate, certain inputs like machinery, buildings, etc. cannot be changed by the firm whenever it's so desired, and it takes time to replace, add or dismantle them. And the short run costs are the costs that can vary with the degree of utilization of plant and other fixed factors. And in other words, these costs related to the variation in output given plant capacity. Short run costs are therefore of two types. One is fixed cost and one is variable cost. In the short run, the fixed cost remains unchanged while variable cost fluctuate with the output. And long run, on the other hand, is defined as the period in which all inputs are changed with the changes in output. In other words, it is that time span in which all adjustments and changes are possible to realize. Long run costs are costs that can vary with the size of plants and with the other facilities normally regarded as fixed in the short run. In fact, in the long run, there are no fixed inputs and therefore no fixed cost. All costs are variable. This in the short run, some inputs are fixed while others are variable, and but in the long run, all inputs including the size of the plant are variable. Both short run and long run cost are useful in decision making, and short run cost is relevant when a firm has to decide whether or not to produce, and if a decision is taken to produce, then how much more or less to produce with a given plant size. If the firm is considering an increase in plant size, it must examine the long run cost of expansion, and long run cost analysis is useful in investment decisions. So activity is here based on this unit and subsection, so please refer and try to do it. In between any doubts, you can contact us anytime. And next is short run cost function. In above section, we have distinguished between short run and the long run. So we also distinguish fixed cost and variable cost. So the distinction between fixed and variable cost is of great significance to the business manager. And the variable costs are those costs which the business manager can control or alter in the short run by changing level of production. On the other hand, fixed costs are clearly beyond business manager's control. Such a costs are incurred in the short run and must be paid regardless of output. And total cost, the three concept of total cost in the short run must be considered. One is total fixed cost, that is TFC, total variable cost, that is TVC, and total cost, that is TZ. Total fixed cost are the total cost per period of time incurred by the firm for fixed inputs. Since the amount of the fixed input is fixed, the total fixed cost will be the same regardless of the firm's output rate. And table 8.1 is here. So this is table 8.1. TFC, TVC, and TZ, MC, AFC, and AVC and ATC. So this is a firm short run cost. Okay. So please refer this from your study material, and in here figure 8.1 total cost curve is here, and one is output Q is here, and TZ and TFC, TVC are here. Okay. And TC is equal to TFC plus TVC. TC is total cost. TFC is equal to total fixed cost plus total variable cost. Okay. And average fixed cost, while the total cost function are of great importance, managers must be interested as well as in average cost function and the marginal cost function as well. There are three average cost concepts corresponding to the three total cost concept. So these are average fixed cost, that is AFC, average variable cost, that is AVC, and average total cost, that is ATC. So AFC is equal to TFC divided by Q. So here is figure 8.2, that is short run, average, and marginal cost curve. So this is output Q, and this is ATC, AVC, AFC, and MC. And average variable cost. Average variable cost is the total variable cost divided by output. And 8.2 is that show the average variable cost function graphically. At first, output increase resulting in decrease in average variable cost, but beyond a point, they result in higher average variable cost. AVC is equal to TVC divided by Q. Q is output, TVC is total variable cost, and AVC is average variable cost. And average total cost ATC is the sum of the average fixed cost and average variable cost. In other words, ATC is the total cost divided by output. So ATC is equal to AFC plus AVC, that is equal to TC divided by Q. Next is marginal cost. Marginal cost MC is the addition to either total cost or total variable cost resulting from the addition of one unit of output. So this is an equation. Here MC is equal to marginal cost. Okay, so delta Q change in output, delta TC is equal to change in total cost due to change in output. So this is a equation based. So please refer your study material also parallelly, so it will more clear. Okay. And next is relationship between marginal cost and average cost. The relationship between the various average and marginal cost curves are illustrated in figure 8.2. The figure shows typically AFC, AVC and ATC and MC curve, but not drawn to scale for the data given in table 8.1. And the MC cuts both AVC and ATC at there. So please refer these two figures. Okay, so it will more clear. Okay, so here is 8.2 short run average and marginal cost, and here is 8.1 is total cost curve. Okay, so please refer that, so it will more clear. So go through this section from your IGNOU study material. And therefore, at the point of intersection, MC is equal to AVC. AVC has just ceased to fall and attain its minimum, but has not yet begun to rise. And similarly, the MC curve cuts the ATC curve and the latter's minimum point, and this is because MC can be defined as the addition either to TC or TVC resulting from one more unit of output. And next is relationship between average product and marginal product, and average variable cost and marginal cost. So there is a straightforward relationship between factor productivity and output cost. To see this, let us consider a single variable factor, that is L, says labor, and all other inputs are fixed, and AP and MP will denote the average and marginal product of labor respectively. If W is the wage rate and L is the quantity of labor, so then TVC is equal to W into L. Okay, and here figure 8.3, that is relationship between AP, MP, AVC and MC. So the here is AP, MP, and here is output is here. Okay, and next is labor input is here, and AVC and MC is here. So this is the 8.3 figure. Please refer from your IGNOU study material, and here is activity 3 based on this subsection. So please try to do it. It will help you for your attainment examination. And next subsection is 8.10, that is applications of short run cost analysis. So in the previous section of this unit, we discussed total, marginal and average cost curve of short run, and the relationship between these cost curves have a very wide range of application for managerial use. And here we will discuss a few applications of this concept. One is determining optimum output level. So how we will determine optimum output level? So earlier we have seen that the optimum output level is the point where average cost is minimum, and in other words, the optimum output level is the point where average cost equals marginal cost. Okay, so this is an example of this same. And next is break even output level. So an analytical tool frequently employed by managerial economists is the break-even chart, an important application of cost functions. The break-even chart illustrates at what level of output in the short run, and the total revenue just covers total cost. Generally, a break-even chart assumes that the firm's average variable costs are constant in the relevant output range. Hence, the firm's total cost function is assumed to be a straight line. Since variable cost is constant and the marginal cost is also constant and equal to average variable cost. So here is figure 8.4, that is break even chart is here. And here is output. This is total cost by total revenue. Okay, so that is break even chart. And break even chart are used extensively for managerial decision process. Under right condition, break even chart can produce useful projection of the effect of the output rate on cost, revenue and profit. Example also here. Next is profit contribution analysis. In making short-run decision, firm often find it useful to carry out profit contribution analysis. The profit contribution is the difference between price and average variable cost, that is P minus AVC. So that is revenue on the sale of a unit of output after variable costs are covered, represents a contribution towards profit. And in our example, since price is 5 and average variable cost is 4, the profit contribution per unit of output will be 1. Okay, and at a low rate of output, the firm may be losing money because fixed costs have not yet been covered by the profit contribution. Thus, at this low rate of output, profit contribution is used to cover fixed cost. And after fixed costs are covered, the firm will be earning a profit. And a manager want to know the output rate necessary to cover all fixed cost and to earn a required profit. Assume that both price and AVC are constant and a profit is equal to revenue less the sum of total variable cost and fixed cost. And here is operating leverage. Managers must make comparisons among alternative system of production. And should one type of plan be replaced by another, and break even analysis can be extended to help make such comparison more effective. Consider degree of operating leverage, which is defined as percentage change in profit resulting from a 1% change in the number of unit of product sold. So this is that. And if the price of output is constant regardless of the rate of output, and the change in the degree of operating leverage depends on three variables: the rate of output and the level of fixed cost and variable cost per unit of output. And this can be seen by substituting a above equation for profit with, so this is the equation. Example also here, please go through it, and activity 4 is based on this, please try to do it. And this is the summary of this unit. And cost concept are important for decision making, but neither the accounting approach nor the economic approach is completely acceptable when decision making is involved. Cost must be considered in various ways depending on the decision at hand, and both traditional economists and traditional accounts have tended to be fairly dogmatic in their definition of cost. And on the other hand, managerial economists want a flexible approach. All the cost concept need to be considered in such a way so as to help make sound decision. The decision maker should try to discover the relevant cost by asking what costs are relevant to a particular decision at hand. And decision maker is not necessarily bound by traditional concept constructed for other purpose. And in short run, the total cost consists of fixed and variable cost. A firm's marginal cost is the additional variable cost associated with each additional unit of output. The average variable cost is the total variable cost divided by the number of unit of output. When there is a single variable input, the presence of diminishing return determines the shape of cost curves. In particular, there is a inverse relationship between the marginal product of the variable input and the marginal cost of production. The average variable cost and average total cost curve are U-shaped. The short run marginal cost curve increases beyond a certain point and cuts both average total cost curve and average variable cost curve from below at their minimum point. And these cost concept and analysis have a lot of application in real world. So decision making process such as optimum output, break even output, profit contribution, operating leverage, etc. And this is self assessment questions from this unit. Try to do it, it will help you for your term and examination, and it is parallel like your assignment. So please try to do it. In between any doubt, you can contact us anytime. And for more MBA series, you just do like, share and subscribe our channel. Thank you so much.
i-tutor Academy presents IGNOU MBA Complete Syllabus Coverage Classes for individual students, semester-wise subject with online flexible timing. For more details, contact on +91 623 827 1885.